give us an indication that we are somewhat close to the final climactic burst to the upside and a further consolidation. And we see in the hindsight that the climactic action happens slightly higher, and in some instances, Bruce, you know, we could label a climactic action here. I remember we had a conversation on this with you, I think. So this could be an alternative labeling as well. But as we go into the consolidation, we go through specific phases. Bruce, and really quickly, could you remind us, you know, why do we need to conduct a phase analysis? What do phases give us in terms of the information, analytical information, as to you know, when we're going to act with our trades on it?
Well, my blog is entitled Wyckoff Power Charting, and I believe that the edge in Wyckoff is that we are able to identify the in this case, a reaccumulation phase is taking place, and we're looking at 10 years, but these occur over 10 years. They occur over 10 months. For intraday traders, they can occur over 10 days or 10 hours. And so we're looking at a very large time frame, but this scales. All these principles scale. And so the reason that we look at phases and what is valuable to us over other approaches to chart analysis is that we're looking at behavioral characteristics in the vertical bar charts. So phase A, and this is also true for accumulation. We can do phase analysis on accumulation. We can do it on distribution. But today we'll do it on this reaccumulation, is that phase A stops the trend. And it stops with a dramatic, sometimes violent move called either a buying climax if it's rallying up into a stopping action, or if it's declining into a selling action, we call it a selling climax. Buying climax in this case followed by an automatic reaction, which is a large abrupt decline. And what happens is this very important information, this is in the blog, is that you have you draw resistance lines, and this is a term coined by Mr. Wyckoff, resistance lines and support lines off of the peak of the buying climax and the low of the automatic reaction. And that is a big sign that we have stopped the uptrend. Now, how remarkably valuable is that information alone?
I was just about to say, Bruce. Yeah, I mean,
say it
in
again.
this area, I was just about to say, Bruce, that, you know, it's such a valuable information in this area right here. I think, you know, a lot of even Wyckoff traders, you know, don't fully place a lot of confidence in this information in this area, because it basically tells you that the trend has stopped, there is a change of character that's coming, and it defines those resistance and support lines for you where price most likely is going to consolidate around the mean. So much valuable information in this area.
So in going, because this we're going to talk about point and figure today, so I'll go really quickly through the rest of this. But that's really important. Emphasize the importance of stopping action. Phase B, the characteristic of prices change. And what happens is you go into this trendless, volatile trading range where the narrative that we tell ourselves as Wyckoffians is that stock is changing hands. What happens is in an uptrend is that you have weaker and weaker holders of the stock that begin to participate, speculate, trade this instrument as the stock is going up. And so then a pause like this is designed to shake out the weaker holders of the stock and allow the large composite operator to be able to accumulate a massive position in the shares. And the way they do that is through trading range activity where they discourage holders of the stock, convince them to sell through the price action. And you can see here that there's weakness throughout this with no trending going on. And that weakness, and where Ramon put that arrow, those big declines, just shakes people out. And the whole time the stock is being systematically bought by very strong hands. And the float is being locked up. And once the float is completely actively locked up, the stock is then in a position to go into a big, long uptrend. And so what happens in phase B is basically large, volatile swings with no price appreciation at all. Phase C is what we call the final testing stage. And phase C is where you have a change of character. You have lows being put in that are not going to be taken out, or the lowest lows of the trading range, or the low in an uptrend is being formed. That low will not be taken out again as the stock begins to slowly, imperceptibly begin its long-term uptrend. And so phase C is the final testing phase. Phase D is the markup out of the testing phase into the uptrend. And then phase E, which is not labeled here but is just as important, is the uptrend. And so we study these different phases for price characteristics, and we become, as Wyckoffians, very, very good at being able to identify these key little nuances that tell us where we are. And so phase analysis helps us to know where we are and also what to do. You know, what are our tactics? How do we buy? How do we accumulate shares? Because we, unlike the composite operator, don't need an entire trading range to be able to buy our shares. We can buy our shares at a point in time and jump on board with the composite operator as they start to see the instrument marking up. And we can just get on board when the stock is ready to move and just be with it on its way into its new uptrend.
Okay, great, Bruce. We have one question from Rainer. He was asking, when prices advanced on diminishing volume or ATR, how can we distinguish between the cause if the cause is lack of supply or whether demand is fading?
This is a good question for Ramon. We've talked a lot about this, about how is it possible that you can have prices rise on diminishing volume, which goes counter to the common knowledge about technical analysis, is that you have to have big price increases on big volume, which can happen. You know, these can occur over as you're in an uptrend. But Ramon, you do a nice job with this question, so I'll give it to you.
Sure. Yeah, so the conventional idea or the conventional belief in the technical analysis is that volume always should confirm the price. And this is true in a lot of cases. But especially since 2009 and working with institutional clients and just with retail traders, you know, a lot of them would come and they would ask the question, why the price is coming up in the uptrend, and yet we see that the volume is contracting, and specifically they're thinking about demand contracting. So we have to think of this type of price and volume action as a function of absorption of the supply. We want to observe the absorption of the supply that has happened throughout the trading range, and then as the price starts having higher lows and higher highs, we're seeing that the volume contracts even further. So supply is contracting at the same time as demand is contracting. And because supply is of such low presence and low quality, a smaller portion of demand, or even sometimes we could say a poor demand, could push the prices up just because supply is not available. Bruce has mentioned that big institutions are going to control the supply of the stock once the accumulation is done, and it's only when they start distributing the stock, or they start distributing that float of stocks that they have in their possession, that's when we're going to have an increase of the supply, and that's when we're going to have the first changes of character for the whole trend. Another way to explain this, actually, let's not go into that. It's going to take some time. But I think that, you know, I've conveyed the main concept here.
Sure, and the big idea here is that the composite operator, as a collection, as a collective, have locked up the float, most of the float of the stock. And so if they own it, they're the only thing that will get them to sell it, which is at the top of the trend, is much higher prices. And so if there's the whole key to an uptrend is that there's demand and the absence of supply. And so the absence of supply means that the stock has been accumulated and put away by large interests that have no intention of selling the stock until it's at much higher prices. And that is the whole cornerstone of the Wyckoff methodology, is the understanding of this principle.
Mm-hmm. And I call this, Bruce, lately passive participation by big institutions. So they are in the position, they are holding, you know, a quite substantial supply of the stock, but they are passive in their participation by not providing the supply, you know, to the market.
And so they contribute to this.
Mm-hmm. Yeah, they're still, and we kind of like don't think about the composite operator in the sense of, you know, active trading in this area right here, but, you know, they are passively still there. You know, by not providing the supply, they are kind of like passively participating in the trend.
Okay.
Okay, so let's go to now the horizontal counts. We talked about the causality that has been created within this consolidation, and then we said that we need specific count lines or points from where exactly we would be taking the counts. And to understand this, we need to understand the count guide that was described so well in Professor Hank Pruden book, which we highly recommend. It's called The 3 Skills of Top Trading. And I just put here all of his writings on the count guide. Bruce, what do we do first when we want to get the horizontal count from the trading range?
Well, we always start at the right side of the chart. So the right side of the chart is we look for what's called the last point of support, and the last point of support is really like the last higher low made in phase C. It's a test that indicates that the stock is no longer pressing downward, is now starting to make higher lows and is starting to rally. And so a last point of support, we find that place on the chart and we count from right to left. And so we would count from the last point of support over to either the climax, the stopping action, which we talked about, which would be like a selling climax or buying climax, and we count from right to left, and on the point and figure chart there will be columns, and columns of X's and O's. And so we'll count how many columns that is, and then calculate from that the potential for how high the price could go off of that accumulation phase. And so we have some examples that we can look at. And
okay. Yeah, let's just go into the example right away. Right, so this is the chart of Apple, and this is the daily chart. This is 2008-2009 trading range, and we already labeled this chart, and we see that one of the last points of support that you've mentioned is right here. It happens after this sprint in phase D, and it seems like by what you said, going from right to left, we would take the count from this point right here on the point and figure charts, and we would go across the whole area of the consolidation into the climactic action. Let's see how it's going to look on the point and figure chart. And this point and figure, and we should mention this right away, this is a 3-point reversal chart. And it's also $1 box size before $100, and then after $100, and we'll talk about this, we have a 2-point box size above 100. So Bruce, here is this LPS, last point of support, and I guess we would be just doing the same thing, right? We would, on the point and figures, we would just project the same count line to the climactic action.
And so that last point of support is the lowest low that it makes there after a sign of strength, so you can show them where the sign of strength is. And so, well, there's a sign of strength in the base, yeah. So there's a sign of strength and then a last point of support. So oftentimes we use, when we see a sign of strength in the base, then we expect prices to slide back down towards support again. And we look for a last point of support to occur, which did, and that was the low that was made prior to the markup beginning. It's the last low that was made prior to the markup beginning. And we find that point on the point and figure chart, and we start counting the columns. And we count the columns across, each one of them, until we get a complete count of all the columns. And then because it's 3-box reversal, that means that it takes three points to reverse the trend. So it's got to go down, it's got to go in the opposite direction by 3 points before you can go over a column and down. So this brings up an important point about point figure, excuse me, as I lose my voice, is that point figure charts are a function of volatility. The x-axis is a function of volatility, not a function of time. And so the only way that you can go from one column to the next column to the right is that you have to have, in this case, Apple reverse directions by 3 boxes. So if it's going down, it's got to go up by 3 boxes at least or more to be able to go over a column and then start plotting upward. And so the only thing that can cause the chart to proceed to the right is volatility in the opposite direction. And so that is what causes a point and figure chart to form. And so what we're seeing here is we're seeing columns of X's and O's. The O's are down columns, the X's are up. That was produced as a function of volatility in the trading range. And so then we get over to the last point of support, which is the last low before the uptrend out of the accumulation range. And we start counting the columns, and we count over to the selling climax, and we get, have a count. Did you count 43? Okay, so now you multiply 43 by 3 because it takes 3. It's a 3-box reversal method. So we multiply by 3 to get our the number of columns that we would use to calculate the upward price objective. So that's 129.
Okay, and we have to multiply it also by the box size.
By the scale.
Yeah, by the scale. Okay, so here that's 129.
Yeah.
Okay, one thing here that we have to make a note of, and this is something that we are definitely not going to discuss today. If you really would like to get into the nuances of how you would make those horizontal counts and projections based on the Wyckoff methodology, please refer to Bruce's blogs, and Bruce has written extensively on this subject. Also, Bruce, I think it's okay if I mention this. On our website, wyckoffanalytics.com, we have a product that Bruce and I created a year ago. We had a P&F series. We recorded that, and if you'd like to have more in-detail review of how we would count, go ahead and just inquire about that product. And there, in those sessions, we go into the details of how we would change the value of the columns based on the price. So, for instance, sometimes we would have the switches where the box size, and we see it here from 95 to 100. This is a $1 per box size here, and from 100 to 110, this is a $2 box size here. And we see that our trading range has some of the price action that is actually above to 100. So therefore, some of the columns, like this one right here, this one right here, this one right here, are going to have a $2 box size for us. So even though we're getting here a count of 129, the actual count, which is the correct count, is going to be 153. And then Bruce.
And this is a hack that we created. Most of the point figure charting engines out there use the scaling convention. Mm-hmm. Over 100 it's 2, and over 200 it goes to 5, and so on, or 250. And so some are a little different, but they all have this scaling convention. And so as a result of that, I created a sort of a hack or a method for being able to adjust for that. And we talk about that in those videos. But there's another hack that you can do, which is in stockcharts.com, which is my favorite point and figure charting engine. You can actually change the scaling so that you're always doing, like say, in this example, everything is $1 scaling. And so you could just have convert the chart to a $1 box size for everything, including over 100. You could do something like that and get a pretty good count. But anyway, so there's ways around this, but it's the result of the fact, like when I started out in the business eons ago, I was doing all my point figure charts by hand, and so these issues were not relevant. But today, because we have these charting engines, they do this, and nobody had a fix for that, and so we created a fix for that, which is very important because it turns out that the fix is very accurate.
Yeah, and I think that we also could mention here another way of depicting the box sizes, which stockcharts.com uses, and that's the dynamic ATR, which I actually like a lot. And
I like that a lot too.
Yeah, in my last class, on the point and figures at Golden Gate, we were discussing with students that particular method of plotting the point and figure chart.
Yeah, so we have an example of that later, so we can show you that, because it's a little obscure, but it's powerful.
Yeah, and there are quite a few nuances there as well. So again,
Yeah.
you know, if you feel like you want to uh, get more in depth with this material, then definitely, you know, this video series would be great. Okay, so we are taking this projection, we are calculating number of columns, we are, um, you know, if we're sophisticated enough, we're going to look into different values of the columns that we have. We're going to count those. And here's the count 153, which was the correct count based on the different box sizes. And we are adding this count to the count line, which was defined by the last point of support. And here is our first target. And this will be the most conservative target for this particular trading range. And then, Bruce, when is the time for us to look for other counts that might be more aggressive counts?
Well, the whole point of doing a point and figure chart is that we're establishing a hurdle rate of return. And we always are looking for a 3-to-1, minimum 3-to-1 reward to risk. And so we're calculating the reward. By calculating the horizontal count, we're getting a $153 price objective in the base. And so the point from which we enter the trade, and there are, you know, classic tactical places to enter the trade, but wherever that might be, so we want to be able to establish that our point and figure objective has at least a 3 times reward to the risk that we're taking at our entry price. And the risk would be the risk from the entry price, excuse me, to the stop.
And I'm just putting here as an example for this concept. So let's say that we have entered this position at about $90 by recognizing that we are potentially going into phase D. There was some kind of swing reversal right here. And then our stop loss would be below the lowest point here where the trend actually starts, so below 83. So looking at the risk in points here, and our risk would be, actually it would be $7. So then we would look at the potential target for us, you know, in terms of how many points potentially we could advance, and we divide it by the points of risk, and we receive our ratio, which is about 22, which is great because we usually would look for 3-to-1, and here we have 22-to-1, which is a great reward to risk ratio for us. That just basically tells us that for every unit of risk that we're going to put out there, we could potentially, and the keyword here, potentially, have 22 units of reward.
So, and the reason that we're looking at Apple, and we actually did this chart in real time in the classroom in 2009, is that it had such an attractive reward potential, and it was showing up even as it was plumbing the lows of the accumulation area. We could see in the point and figure chart, we could see a huge reward potential in the stock with a very manageable risk in terms of where to place the stop. And so this was a stock that was revealing itself as being a very appropriate candidate to participate in the 2009 accumulation range for the S&P, and Apple was certainly among the leaders. And so this was a real-time case study that we did, and we continue to show it because it's so powerful. And 22-to-1, well, the 3-to-1, you're going to get bigger reward potentials on 3-box reversal charts because they're like, think of it as being akin to a weekly chart, where we also do 1-box reversal charts, which are more like daily charts. And when you do daily point and figure charts or one box reversal point and figure charts, the counts are smaller. You might get a 6-to-1 reward to risk or a 4-to-1 reward to risk on a 1-point reversal method, and it would still be attractive in the shorter time frame.
Okay. So now let's come back to our case study of Biogen. And Bruce, you'll have to explain here, what kind of chart this is, because I'm looking at this and I see that there is a 3-box reversal. So that's very common for us. But then you have a very, very big box size here of $5.
Well, this is one of the reasons that stockcharts.com is which is where my blog is my favorite tool for doing point and figure analysis. And that is that we can modify our charts. We have great control over the construction of our point and figure charts. And so here, the most important thing I want to get across here is that we needed to create a modified count because this point and figure chart is 10 years wide. And so all I want to do is get across the point that we can compact our data and still get really good counts that are useful to us. Now, most people aren't going to do 10-year point and figure charts. And most people are going to be focused on one point reversal, one box reversal, 3-box reversal, and they're going to be looking at daily and weekly time frames. I get that. The point that I want to make is how robust horizontal point figure counting can be, because this is a remarkably long time period. So what we've done is we've taken from the last point of support and we've counted all the way across to 2000 to the complete an objective of 415. 395 to 415 is our objective.
And what was the count line, Bruce? 40?
40.
So,
and then we always count from the low. So we take the 375, we add it to the low, and we add it to the count line, and that gives us a range. All we're trying to do is establish a range. We just want to get close with point figure charts. We don't expect perfection, even though we get it often. We're just looking for, getting close. So
right.
that's a remarkable objective. It's like, oh, this $40 stock could go to 415. It's like, honestly, it's just this huge count. And we were able to make this count because we had used a modified version. And so it's like, can we do a modified count and have any kind of precision in that? And so we can take and there's an interesting point here in this little box on the bottom. Remember how I talked about how the x-axis is a function of volatility, not of time? Well, the first half of the point figure count takes 3 years to form. So there's a lot of volatility in the first 3 years of time. And so the second half of the chart takes 7 years to form. And that means that the volatility is decreasing as you get further and further into the reaccumulation. And what that tells you is, well, one, point figure charts are a function of volatility, not a function of time. And it tells you that the stock is being absorbed because in the second half of the chart, the volatility is coming out of it. It's less and less and less volatile. That is a classic sign of a stock under accumulation. And so,
the whole system could be just based on the decrease of volatility on the point and figure chart,
yes,
through the traded range.
And that's an accumulation. And this is also, I've written about this in the blog, so do have a look at that. Mm-hmm. In distribution, it's the opposite. Yeah. The volatility begins to be reasonably high at the beginning of distribution, but becomes more volatile as you get to the end of distribution, because the composite operator types are no longer supporting the stock. They are distributing the stock. They're selling it, and that inherently creates volatility. Mm-hmm. So distribution is the opposite beast of accumulation.
Really, really good point, Bruce. I want to mention and stop here. Let's talk about the range. Some of the students, would just take these numbers as something very, very strict, that numbers that they're going to follow, and they would expect that the price is going to kind of like have the last tick at 415 area or something like this. Wyckoff would say that the range or the target area would be a place where the price would stop, and we would have to watch and listen to what is happening in that area. So there are quite a few possibilities that could happen there, and the primary possibilities is that the stock can have a stepping stone, so it could develop another trading range, or this trading range could be a reversal trading range, to the uptrend that we've already had. So as a rule, we use the target area or the range here as a guideline for us to look for any type of changes of character, any type of development of the trading ranges, or any patterns that are reversal patterns in this area. Okay, great. Bruce, so let's look at on the vertical where actually your count took us. So the count was on the $40 line, I'm assuming probably somewhere right here, or even this low right here. And then we see that you have the target area right here. And I can't see really the pricing here, but you had it 415 and 395.
Yeah.
Yeah, and I think that the price went above this, maybe like what, another $40-50, which is remarkably close. And again, we are coming to the idea, to this area with an idea that we're looking for any type of distribution patterns or any type of changes of character patterns where that would tell us that the reversal is going to happen, or we're going to develop another trading range. And this is very close, Bruce.
You can see that last run-up is a climax. It's a buying climax. And that is a exhaustion move, which we know that when you get a buying climax, you draw resistance, draw support, and so we expect that the trend is going to pause at best, reverse at worst. And you can see it happen right into the P&F objective that we created with that modified chart, which is remarkable. But that's how powerful this tool is. And so I'm not going to say it's easy. Horizontal accounting takes a lot of practice, but it's well worth learning it and becoming good at it.
And primarily, Bruce, just from my experience teaching this material and using this, in some instances. I think that the biggest mistakes from people that I see is that they don't follow the study guide or the account guide. I think it's very crucial for those of you who are going to be inclined, to go and develop the understanding of this material to study the count guide to the last letter so that you would know exactly how to create those horizontal counts. Another thing that we often discuss with Bruce is at the $40 range, and let's say that for all of the points of entry that you're going to have on the way up in phases C and D within the structure of the change of character, it's a great mental convincer strategy, and this is Bruce's term, to stay within the trend until you actually hit a target area. Bruce, can you in a couple of sentences talk about this, talk about the mental convincer strategy here?
Well, I think horizontal counting is very valuable because what it does is it establishes the potential for the trade. And when you get into these inevitable pauses in the uptrend on the way up, and there's another whole school of analysis we can do, which is trend analysis, which is a subject for another day. But we are, this was what allows us to be able to hold through these inevitable pauses that are going to occur. And this is the convincer strategy that we just stay, we're constantly revisiting our point figure objectives. We're constantly going back to them. And oftentimes, we can do point figure objectives of the stepping stone reaccumulations, which Ramon circled. We do point and figure chart counts of those, and they will count up towards the ultimate objective at the highs. So they'll stepping stone reaccumulation counts and confirming counts. And so we can do point figure counts on those too. And so we just stay focused. And what we're looking for is we're looking for that classic change of character. We're looking for the climactic action and the reversal that tells us that the trend is over. And so we again are always going back and forth between the point figure and the horizontal and the vertical charts and looking for those telltale signs of stopping action and conclusion of a trend and so on.
Okay, great. So that was...
Yeah, so let's look at a few more that we have because those are smaller time frame. This is a little bit of an abstract example, but it's very valuable and it shows how robust it is.
Plus it's current, so it's great.
Excuse me.
Roman, sorry, Bruce, we have one question concerning the previous slide. Where do you see the change of character in phase C and D versus the last uptrend which led to the upthrust in phase B?
Okay. Well, as we're observing the price action in this area right here, phases C and D, what we are noticing is that the rally is becoming the largest rally that we have seen in the trading range, and we are obviously comparing everything apples to apples, so the rallies are going to be compared to the rallies and the reactions, and see how shallow this reaction is on the backing up action. All of the previous reactions in the trading range, we see how, substantial those reactions are. So there's something different that's going on with the price action. We also, for the first time, committing to the upside above the resistant cluster that was created by the upthrust action and by the climactic action in phases A and B. We also can look at the volume signature as well. So something different should happen there as well. And we see how throughout the trading range we still have a lot of pockets of the supply that basically tells us that there is a lot of exchange of stock in this area from weak hands to stronger hands. And then as we go into phase C and phase D, what happens with this supply? There is a contraction of the supply, and that's a change of character by itself. So one of the ways, to think about this concept, the change of character, I always say this, catch the change of character on the way into the trading range, and this is where a lot of your trading decisions are going to be made, whether you're holding the position or whether you're considering opening the position, and maybe it's too late already in the trend to do that. So don't necessarily, come in on the change of character reaction like that. And then the second place where you're going to have a lot of trading decisions is in the area of the change of character out of the trading range. So we want to be extremely active with our decision making in these two areas, and these two areas are going to have attributes and characteristics that are going to be different from the environment that precipitated, a change of character. So the change of character here in C and D is going to be different than in A and B. And then change of character in A is going to be different than anything that we've seen before on the way up. Okay.
Yeah, that's a very good question, and that we could spend hours on the subject. But just one minor tip. You'll see there in phase B that there's a run-up and a failed-up thrust. And what is meant by that in the failed-up thrust is that peak is lower than the peaks that preceded it, including the buying climax and so on. So there wasn't enough oomph in it to get what we call a sign of strength. So that shows that they're selling at the top of the trading range, and we would just expect it to go back to the bottom. That next upthrust action, we could also call that a sign of strength, because it not only takes out the prior peak, but the peaks where is labeled secondary test. Now, once we see that, we know there's enough power, buying power, to temporarily take out the resistance area, and we can, after being in the trading range for a long time. So automatically our thought goes to this next decline towards the bottom of the trading range. We expect it's going to be a last point of support. Now, that doesn't mean it can't go all the way back down to the bottom, but now our antennae are up for an LPS. And so we look for that, and then we look for a change of character. And you can see that each one of these reactions after the LPS are very shallow. They're all shallow. And so we go with that. We go with those with the expectation that that's an LPS and that we put in the final test. So signs of strength followed by an LPS is a little nuance that is a very powerful nuance. Does it work every time? No. But if you don't get a sign of strength, then be very patient, because a continuation of lower highs throughout the trading range shows that there's sellers over the market. Until you can prove that the buyers are in control, don't trade it.
Okay, awesome.
So let's move on. It's like I used up a lot of time with that. But here, this is in my last blog post, and there's two examples here. Late 2015, a distribution is formed, a cause is built. This is a 3-box reversal chart of the Dow Industrials 50-point scale. And so 3-box reversal, 50-point scale. So what we do is we count the columns, and so we count from the last point of supply, which is the last push up before the markdown begins. We count across, and we get the number of columns, multiply that by 3, and then multiply it by the scale, which in this case is 50 points. And this is the count that we got, which went down to 15,500 at the low, 15,750, and so you can see that that was an exceptionally good distribution count. And then you can see after that, so what does it do? It climaxes into our count objective. And so we're looking at the vertical chart going, oh my goodness, here it is climaxing right into our count objectives. So we then have like two conclusive pieces of evidence that we're going to stop there. Now we may stop and build another distribution, but we're going to stop there and we're going to build count. And in fact, we built an accumulation count. So this is a gigantic trading range. And so you can see here then, we go through and we count from, we see our sign of strength on the point and figure chart. We have a sign of strength, and then we back up so we know that after the sign of strength we're looking for a LPS type of action. Then we, once that is in and turns, we can buy that turn, and the more aggressive of us might buy the test of the lows where the 15,500 objective is. So we see that it's a higher low, we might buy that. And we count across, and we have a count here that goes 18,350 to 19,050. And we've gotten all the way up to 18,150. I wrote about this, I published it yesterday. And so we got very close to fulfilling the objective, and so potentially the lower objective of 18,350, 200 points, it's possible that that's all we get, but it's also possible that we may reaccumulate here and then attempt to go to a new high and go up to between 18,350 and 19,050. And so that is a remarkable chart. I published that in real time in the blog back in February, I think February 19th, I did a blog. You can look at that. And then I also did a point and figure chart, I think, at the in January 16th. So you can go look at that and see some real-time analysis of those of these charts as they were unfolding. So, anything more to add to that, Ramon?
No, I just think it's in my experience, those counts that we have for the swing trades are so remarkably good, and it works so well in the 2016 and to a certain degree in 2015. Let's look at the intraday. Because that was really interesting. I don't use the point and figure on the intraday, but I know that you do. So walk us through this chart here.
I was going to make the point that the Dow Industrial Average, you may never trade that. You may trade other instruments, but if you want sort of a feel for the market, I notice that the counts that you get on the Dow Industrial Index tend to be very good counts, and so I tend to look at those a lot, and I tend to publish those more often. It's because the counts tend to be so good.
Yeah, before you go into the explanation, let's talk about this dynamic ATR feature that we have here. So the box size is different. What is it based on?
Well, there's a calculation of the average true range, the volatility of the last 20 days, and Stock Charts does this for you, and it's very, very good. And what it does is it calculates a scale on the average volatility of the past 20 days. And so each one of these divisions on the scaling is 12.37 points. And so if you go, like, this is a 5-minute point and figure chart. So I went all the way down to 5-minute data to show you this. Now you have to have a subscription, at least a basic subscription to stockcharts.com to be able to do intraday point and figure, but it's way worth it. And also you can save your work. If you get a subscription, you can set up directories that save your work. So here you can see there's a downtrend that started at 146.79, this downtrend, and then it went into a stepping stone. And it's a stepping stone redistribution. And you can see that it rallied up to that where I have the 28, that's 28 columns, but where it went up to 28 and then it reacted very swiftly down that is the climax and the automatic reaction. So that sets the range of our trading range in our stepping stone. And then we have an upthrust action, and the upthrust action is followed by a push all the way back down to the bottom of the range, and then a last point of supply. And so we then find the last column where prices turned up. Now it's a one box reversal, so it turned up and then it just collapsed out of the range. There you take your count. You take your count from the point at which it collapses out of the range over to your buying climax and your automatic reaction, 28 columns. And you can see, even though this is a teeny tiny little 5-minute, that's 4 days of data right there. So just because it's 5 minutes doesn't mean you're not seeing a lot of data. That's 4 days right there. And then it goes down and gives this beautiful count down to 17,664, and from 18,035-ish, somewhere in there. And so beautiful count. And then it turns around and you can see there's this nice little accumulation and a jump out of that, and it rallies up to 17,868 off of that 15-column accumulation. So for short-term traders, whatever the instruments you're trading, this intraday data can be converted into point and figure charts, and you can do counts. Now the counts come and go quickly, so you got to be on your toes, but you're on your toes anyway if you're an intraday trader. But this is really powerful stuff. So anyway, I just wanted to show that. I put that in this blog post also.
Okay, let's proceed to, I think this is the last chart that we have, and this is an S&P.
So here, I just took the S&P. You can see there's a classic accumulation taking place in early 2016, and you have a count line and a low, 1900 and 1820 on the S&P, and you can count across. I did this as a one-box reversal chart so that you could see what one box is, because now when you count the columns across, you count the number of columns, which is 19. The scale is 10, so it's 19 times 10, or 190 points. And then, so it's one box reversal, so you just count the number of columns, and then you count upward or downward the number of columns to get your objective. And so you count 19 columns up, and you're going to get, from the low, you're going to get an objective of 2010, and from the count line, you're going to get an objective of 2090. So look what happened. It had a nice trend upward, consolidated that trend. It got into the midpoint of the price objective, consolidated in there, and then it looks like climactic action, and it went 2 boxes above the high objective to 2110, and then reversed. So it appears that we have a change of character, because this is a correction that is vastly different from anything that's preceded it in the uptrend. And so a wonderful tool. It ends with a crescendo, this big push-up goes, and so you can see we're not looking for perfection here, we're looking for ranges. And so it gets 2 boxes above, and it climaxes right into our price objectives, and then it falls right back in again. And we get a change of character. All of a sudden prices go from, persistently pretty stable and strong to all of a sudden prices are weak as our price objectives are fulfilled.
Mm-hmm. I love those areas where we have some kind of longer term resistance, and then we have the reversal right on that resistance point, something like this. In a lot of cases it just shows almost like an upthrust action that fails instantly, and it's a really, really good analytical tool.
So
okay.
The videos that we did last year go into much more detail on all of this. You'll also be able to get more information on the blog because since late in last year, there's a couple that you might. Do we have a second where I could just sort of point them to a couple of them?
Yeah.
So I did on 12/17. Get a pencil out and just write these dates down because that's the best way to find these because they're in the order of when they were published. 12/17, I did a crude oil case study because crude oil was going into the low, and there's a nice case study of point and figure counts in crude oil, very long-term point and figure counts, and so where I compare the vertical chart to the point and figure chart, and then on 2/26 I have an update of those charts. Crude oil exceeded the objective that was made at the peak by one box. It was just such a powerful case study. And then on 11/14 there's a case study on Cisco, which is a stepping stone redistribution case study. January 22nd, P&F magic, point figure magic is tips and tricks and guidelines, which is some of the things we talked about today. And so that's a really good one for just, sort of the little nuances of point figure counting. There's a good one on what I call the point figure distribution paradox, why you don't want to overcount distribution, and I used an example of Tesla. And Tesla this is on February 12th, and why you want to take small counts on these objectives and not take the gigantic count, and why it's more effective. So anyway, so you can look at those, and there's others to look at, and also you can subscribe to the blog. At the bottom, then you just click on a button. Your information is not shared with anybody, but every time I publish a blog, you're going to get an announcement as an email with a link so that you can go right into it.
I think you have to go to the actual blog and then go down and here it is. Would you like to receive an email notification? Okay, and you press yes and you subscribe.
So.
Okay, great. I can't reiterate how great Bruce's blog is, and for all of my students, it's a requirement, to read Bruce's blogs. So much valuable information on the method, and it's free. It's completely free. We mentioned a couple of things. So one of them was the Wyckoff point and figure course that Bruce and I had a year ago. So this is one of the slides from that course, and we were looking at the Dow Industrial and all of those point figure projections. And if you'd like to purchase that, just go ahead. Also, we'd like to mention that we are going to have, starting from next week, we're going to have 3 webinars that we call Conversations with Wyckoff Wizards, and it's all based on Bruce's blogs. So we'll pick up probably most memorable to Bruce and to his team, blogs, and we'll talk about the Wyckoff concepts there. This is a very inexpensive 3 sessions, just $49 for all 3, and we're going to meet for 3 Mondays from 4 to 6. Pacific time. If you're interested, just come to our website, subscribe, and
if you miss one, you can't make them all. They're going to be recorded, and the recordings will be available to the attendees.
Yeah. Okay. So we mentioned the Conversations with Wyckoff Wizards. Obviously, we'd like you to check out any sources that we have on Wyckoff material. We talked about Bruce's blog today. We talked about Wyckoff Analytics, but also please do go to the Golden Gate University website, and we have the whole TMA program, Technical Market Analysis program, that has other classes as well. So, for instance, a FI 352 class is being taught by Brett Villome in association with Martin Preen. So that is a very interesting online class that is going to take place, I believe, in fall. We have 2 Wyckoff classes, and for those of you who are in Bay Area in the United States, you could attend those classes on campus with Hank Pruden, and we definitely recommend highly, to take at least one class from Hank because it's just such a great event. And we also have online Wyckoff classes if you are not in the region. So you can sign up for those. The online class is usually conducted in spring, so the next cycle is going to be in January. It's going to start in January of 2017. And also check out other offerings that we have. There are quite a few classes. We have about 8 classes right now that are all online and that are all about technical analysis. If you have any questions, obviously you can email us, and Bruce, I think that people could reach out through your blog, right?
Yes, there's a comment section on the bottom, and you can ask questions down there.
Okay.
Yeah, that's probably the best way, and then everybody can see the question, and then I'll answer them.
Okay. If you'd like to reach me, just go to Wyckoff Analytics, and you can find information on how to reach me there. I think that's it.
Do we have
any questions?
Do we have time for a question?
Yes, just we have only one from Dylan. How do you draw your price objective? Is it by stockcharts.com or you do it manually?
Manually, yeah. So Bruce, this, like this red and green lines right here.
This is the thing about horizontal counting, is it requires judgment. Vertical counting, they can program that into the computer. So when you see objectives, point figure objectives that are generated on the computer by the computer, those are vertical counts. Horizontal counts require the judgment of knowing where to start them and where to end them, and so we have to do those counts, those horizontal counts, manually.
And as an automated feature, I think StockChart has a vertical count, so sometimes they would, or is it gone already, Bruce? Did they take it?
Yeah, they have. They'll do vertical objectives, and yeah, and they'll actually do screens on vertical objectives if you care for that. But the vertical objectives are different from the horizontal method, and I think that the horizontal method is kind of a well-kept secret because it kind of requires a certain amount of work to go through and do these point figure charts. What happens though, and the reason I always is because you become better and faster at being able to see the proper counts and be able to post them up on the charts. And so practice is what's required to be able to cycle through a lot of charts quickly and accurately.
Okay. Akram, are there any other questions?
No, we don't have. That was the last question. So thanks to you, Roman and Bruce. It have been a very interesting approach today. And let me go back to my screen.
Well, Akram, thank you, IFTA. It's been a lot of fun to do this.
Yeah, thank you, Bruce. Thanks. You're most welcome. And
thank you so much.
And actually, let me remind everyone that this presentation will be recorded and will be delivered to each society in a week. So thank you one more time, Bruce and Roman, and have a good night. Have a great day, everyone, wherever you are, and see you in the next webinar. Bye bye.
Wonderful. Bye bye.
Thank you so much. Bye bye.